Today we are going to talk about non-owner occupied home equity lines of credit. These are home equity lines on a property you don't live in. We're going to go into this in a whole bunch of detail. You're going to learn how to do it, the pros and cons, and the best ways I know. All right, guys, if you've got questions, you can type them in down below. Any question just like this one about non-owner occupied home equity lines of credit, and I will answer it in a video and create one just like this for you. So if you have questions, type them in the comments below and I'll put a video together just like this. So home equity lines of credit. It's pretty easy to go out there and get an equity line of credit against your own primary residency. You can go out there and do that pretty easily. They'll typically do a second loan on a property, meaning it's a subordinate or second position to your first loan. So let's say you have a first loan where you owe $250,000, and if there's some equity in the property, typically they'll go up to like 90%. If there's additional equity in the property, they'll give you a line of credit for the additional money in that property. So let's just use simple numbers here. Let's just say your property is worth $100,000. That means if you had a loan on the property for $70,000 and the home equity loan would go up to like 90%, sometimes it'll go up to 95%, you could go to a bank or a credit union and you could get a line of credit for $20,000. The idea being you owe $70,000 on your first loan and they're willing to go up to $90,000 or 90%. Means there's $20,000 worth of equity you could get on a line of credit. I recommend that you do this. This can work out really well for real estate investors, but you've got to be very careful with what you use the money for because you are putting your house at jeopardy, the place that you live. Keep in mind it's already at jeopardy because you already have a loan against it, but these funds, you need to be very careful how you use them. Don't just take them and go to Disneyland or take the family on a vacation or something. You've got to be very, very careful with this. But it could be very useful if you need to come up with some money on a deal, or you come up with some money that can make the difference between you doing a deal and not doing a deal. Those things can work out really well. That's a homeowner line of credit. Basically, the home I live in, I'm getting a line against the property. Now, what you're going to run into is what are called non-owner occupied. That means you don't live in the property, and what you're trying to do is get a line of credit against that. Now, in most cases, I have not been able to find a lender that is willing to do a second line of credit, meaning if I have a first loan for that $70,000, but this is on a property that I don't live in, I have not been able to find a lender that's willing to give me a loan in second position on a non-owner occupied line of credit. That said, if you're aware of any, please type it in the comments below because I would really like to know that. But what I am able to find is lenders that are willing to do a first line of credit. So basically what this would mean is you would have to have the property free and clear, or you would have to use the line to pay off the existing loan that you have on the property. So in the example we were talking before, if you owed $70,000, you could get a line of credit. Now, typically, if it's non-owner occupied, they're going up to 80%, and in some cases, it's only 70%. So if that property was worth $100,000 and it was a non-owner occupied property, most lenders are going to go up to 80%, occasionally 70%, meaning they'll give a loan up to $80,000. So for order for you to tap into equity, you would get the $80,000, you would pay off the $70,000, and you'd have $10,000. I don't really recommend it in that type of scenario because you don't have a ton of equity you're tapping into, and now that interest rate on the equity line of credit is a variable interest rate where you probably had a fixed interest rate before. But let's say you only owed $20,000 on the property. Now, if you owed $20,000 on the property and you could get up to $80,000 or 80%, and you could tap into $60,000, that might be worth doing. But keep in mind the risk here is that the interest rates would fluctuate and that could drive your payments up or down. So you've got to be prepared for that. However, it can work out really well if you're trying to take money from that property to go to the next property. Now, a lot of people will do, they'll take money from their home and they will get a line of credit against it, and then they'll use that money to then BRRRR into a property where they're coming up with as little money as possible. They're buying the property, they're refinancing, they're buying the property with hard money, they're fixing the property up with hard money, they're refinancing that property. If there's some additional cash they're using off their line of credit, they're then refinancing that property. They're getting into that for very little money, and then they're able to use that money off their home equity line to buy a third property. They do a BRRRR strategy again. Check out, I've got a great video on BRRRRs that can help you, but that's kind of a snowballing idea of trying to get more properties where you get the first one to get to the second one to get to the third one, and you can snowball into those properties. So check out my BRRRR video on that. So if you want to get these lines of credit on non-owner occupied properties, you're gonna have to make a lot of calls. This year I've gotten 2 of them, I believe, maybe 3, where I've gotten a loan that's a non-owner occupied property, don't live in it, and I wanted to get a line of credit against the property. I had to call 20 or 30 different banks and credit unions, and come to find out there was only like 3 or 4 that was willing to do that. So I had to make a lot of calls. What I found locally is my credit unions were the best bet at that. And so I would recommend you talk to a credit union and ask that credit union, and what you're saying is, do you do non-owner occupied lines of credit? Do you do those? And you want to ask them if they do in first position or if they'll also do them in second position. Again, if you can find somebody that's doing those in second position, let me know. And it may just be regional, or it may be state. It may be a specific credit union only in your state that's willing to take on that product. But if you do, I'd still like to know. Put it in the comments below, because this can be very helpful for real estate investors. Now, the question is, what do you do with this money? Well, you can take this money and you can buy a property. You can take this money and you can put it towards the purchase of a property. So maybe if you have a property that you owe $50,000 on and it's worth $300,000, you could get $200,000, and you could use that money to then go buy a fix and flip property. Or you could use that money to go towards a fix and flip property and get a hard money loan for the rest of it, lowering your overall costs, because then your overall cost of the hard money's, your hard money cost is the same, but your overall project cost goes down if you're bringing a considerable amount of money. Now, typically these lines of credit are tied to prime, the prime interest rate, which means they're going to go up and down. Like for mine, they adjust monthly, and there's a variable, so they're like 0.25% above prime, but they typically also have what's called a floor and a ceiling. A floor means they'll never go lower than this amount, and a ceiling means they'll never go higher than this amount. So on one of my lines, I think the floor is 3.5%, and I think the ceiling is like 12%. So meaning it won't go lower than 3.5. So if prime was at 1 and the margin is 0.25, that should be at 1.25, but they say, oh no, 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 the floor is 3.5, so we bump you back up to 3.5. So that's kind of how the floor and ceilings works when you're dealing with a line of credit. And that's going to be the same regardless if it's a homeowner line of credit or it's a non-owner occupied line of credit that we're dealing with here. So if you would like to get a copy of my rental calculator, you can text over to 435-294-0433. Text your email address and we'll send you a copy of the rental calculator. I also have a blog on the 16 ways to get 100% financing for fix and flips. I'll link that in the comments below. I'll put the phone number to text us in the comments below as well. I have another great video on how to get cash out refinance on a rental property that goes in more detail on this. You're going to want to check out as well. Otherwise, make it a very profitable day, and bye for now.